Welcome to Griffonomics. So, um, imagine a company whose revenues are just absolutely exploding. We are talking up 25% year over year,
Right.
hitting an astonishing $1.77 billion in a single quarter.
Which is a massive number.
It's completely insane. And their profit margins on specific transactions, they're jumping 40%. So by all traditional accounting measures, they are executing this flawless early cycle operating inflection.
Yeah, on paper, it looks incredible.
Right. But here's the catch. If you look at their cash flow statement for that exact same quarter, they are bleeding $42 million in cash.
A massive cash drain.
Exactly. Plus, they are sitting on an elevated debt ratio, and they're navigating this industry-wide legal earthquake that is literally bankrupting their competitors left and right.
It's a chaotic environment.
Truly. So today on the Deep Dive, we are unpacking the ultimate early cycle paradox. We're looking at RXO, trading under the ticker RXO.
Yeah, and it really is a phenomenal case study. I mean, it shows how the physical economy is currently colliding with all these complex financial mechanics.
Yeah, for sure.
RXO is this massive asset-light freight brokerage. And that asset-light part is key. They don't actually own the trucks.
Right. No physical fleet.
Exactly.
Yeah.
They operate as these digital matchmakers. They sit right between the massive corporate shippers who have cargo, big box retailers, automotive manufacturers, and the independent carriers who actually have the physical capacity to move that cargo.
So they are essentially the air traffic controllers of the supply chain.
That's a great way to put it.
But they are operating in an environment right now in mid-2026 that is just incredibly chaotic. So for you listening, whether you're an investor looking for an asymmetric recovery play, or maybe a logistics professional, or honestly just insanely curious about how the physical economy actually operates behind the scenes, this deep dive is going to reveal the hidden levers of supply, demand, and AI in the real world.
And we have a really solid stack of sources for this one.
We do. We've got their Q2 2026 SEC Form 10Q, executive summaries, forensic financial audits, and the full transcript of their Q2 earnings call.
Yeah, and that earnings call is fascinating because management really had to answer to some highly skeptical Wall Street analysts.
Oh, I bet. So our mission today is to figure out how this massive financial paradox actually works in the real world. I mean, why are they bleeding cash while revenue skyrockets?
Well, to understand the cash flow and the revenue and the margin expansion, we really have to first understand the macroeconomic battlefield they're fighting on.
Okay, set the scene for us.
Because right now, the freight market is undergoing this violent structural supply-side recovery.
Which is a big shift.
Massive. For the last couple of years, the logistics industry has been trapped in a prolonged freight recession. During the pandemic boom, basically everyone bought a truck, which led to way too many trucks chasing not enough freight.
Right, basic supply and demand.
Exactly. But the documents from Q2 reveal that this dynamic is suddenly and aggressively reversing. And the catalyst isn't a booming economy.
Wait, if it's not the economy, what is it?
The catalyst is regulatory enforcement.
Okay, the Federal Motor Carrier Safety Administration, the FMCSA, the government is stepping in. But what does a regulatory crackdown actually look like out on the highway? We aren't just talking about a few speeding tickets here, right?
Oh, no, far from it. We are looking at a coordinated, multi-tiered enforcement mechanism. And again, just looking neutrally at the facts and the sources, this is structurally removing trucking capacity from the North American market.
Okay, break that down. How are they doing it?
The sources detail 4 specific federal actions. First, the FMCSA is strictly enforcing English language proficiency standards for all commercial drivers.
Got it.
Second, they are actively shutting down what the industry calls CDL mills.
Wait, CDL mills? Like diploma mills, but for commercial drivers?
Exactly like that. These are essentially fraudulent entities that were rubber stamping commercial driver's licenses without requiring any rigorous testing.
So people who had absolutely no business driving an 80,000-pound missile down the highway were just like buying their credentials.
Essentially, yes. It's a huge safety hazard. And the third action targets illegal cabotage.
Cabotage. Okay, define that for us.
Cabotage laws dictate that foreign carriers, so say a trucking company based in another country, cannot move point-to-point freight entirely within U.S. borders.
Meaning they can't just act like a domestic trucking company.
Right. They can bring freight in,
Mhm.
or they can take freight out, but they cannot operate domestically. And the federal government has completely halted that illegal domestic operation.
Okay, so that's 3 big sweeps.
Yeah, and the culmination of all these crackdowns is the fourth and honestly most staggering data point, the disqualification of roughly 200,000 non-domiciled CDL holders.
Whoa, wait, 200,000 drivers.
200,000.
Suddenly just legally erased from the market. That is insane. I mean, we are looking at a massive game of musical chairs here. But instead of adding more players to the game as the music plays, that the federal government just walked in as the bouncer, locked the doors, and kicked a quarter of the players out of the room.
That's the perfect analogy. The chairs are the freight loads, and the players are the trucks.
Right.
And the data indicates these regulatory actions have effectively removed up to 25% of the for-hire truckload capacity from the entire market.
25%. It is just a massive attrition of physical supply.
It really is.
But, okay, I hear that, but let's push back a little.
Yeah.
Because if the overall economy is still soft-like, if consumers aren't buying as many TVs or as much patio furniture, does it even matter that those trucks are gone?
That's a very fair question.
Right, because if I have 10 loads of freight and 20 trucks, kicking out 5 trucks still leaves me with 15 trucks. That is still too many trucks for the amount of freight. So how does that tightening actually give the remaining truckers any leverage?
That is the core macroeconomic question. And we have to look at 2 intersecting freight metrics to really find the answer.
Okay, lay them out.
So you are entirely correct about consumer demand. The Crass Freight Index, which is the primary industry standard measure of actual freight shipment volumes, has remained heavily subdued.
It's like historically low.
It has been down year over year every single month since January 2023.
Wow, over 3 years of decline.
Exactly. There is absolutely no demand-side boom right now. But, and this is the crucial part, despite that soft demand, industry tender rejections crossed 18% in June of this year.
Okay, tender rejections. For those of us who, aren't deep inside the logistics bubble, walk us through the actual mechanics of a tender rejection. What is actually happening in that specific transaction?
Okay, imagine a massive enterprise shipper, let's say a national grocery chain.
Okay, I'm picturing them.
They have a contract with a carrier to move a load of paper towels from Atlanta to Dallas every Tuesday. And they have a locked-in rate of, say, $2 a mile.
Sounds standard.
It is. So when Tuesday rolls around, the shipper's computer system sends an electronic tender to that contracted carrier.
Yeah.
It's officially requesting the truck.
Right.
A tender rejection happens when that carrier's dispatcher looks at the screen, sees the load, and hits decline.
They just say no.
Exactly. They are essentially saying, no, I am not taking that load at our agreed-upon contract rate.
But why would they turn down guaranteed work? Especially if demand is soft.
Because capacity has suddenly become so constrained that 18% rejection rate is actually a 4-year high for the industry.
Oh, wow.
Yeah. Even though there isn't a surge in new freight, the sudden disappearance of a quarter of the trucks means the remaining drivers are no longer desperate for every single load.
I
They know that if they reject that $2 a mile contract load, they can just log onto a digital load board and find a desperate shipper willing to pay $3 a mile.
Because that shipper's original truck got disqualified or whatever.
Precisely.
So it is a supply-driven recovery, pure and simple. I mean, the market isn't tightening because we are buying more goods. It's tightened because there are fundamentally fewer trucks legally allowed to move the goods that do exist.
That is exactly the dynamic.
Okay, so let's play out the scenario for that grocery chain. Their contracted truck just rejected the paper towel load. But the paper towels still have to get to Dallas, or the shelves go empty and people get mad, so the shipper is totally backed into a corner.
And that desperation forces the shipper into what is known as the spot market. And this transition, this shift from stable contract freight to volatile spot freight, is the primary engine driving RXO's current financial surge.
Right. And just to really clarify this for everyone listening, think of contract freight like booking your Thanksgiving flight back in August.
That's a good comparison.
You lock in your rate, you know exactly what you were paying, and the airline knows you are showing up. It is stable, predictable revenue for them. But the profit margins are generally thinner because you bought early and you shopped around.
Exactly. It's planned.
But spot freight is the equivalent of your car breaking down on the Tuesday before Thanksgiving, and you show up at the airport counter absolutely desperate for a ticket to Chicago right now.
Right. You have no options.
You are buying that ticket in real time at whatever the market price dictates in that exact moment. You have zero leverage. So the airline can charge you a massive premium.
The desperation premium. And the numbers from RXO's Q2 earnings reflect this dynamic perfectly.
Let's hear the numbers.
Because of that 18% tender rejection rate across the industry, shippers are bleeding freight into the spot market. And RXO capitalized on this aggressively.
I bet they did.
Their spot volume surged 1,500 basis points year over year.
Okay, let's translate that financial shorthand for a second. 1,500 basis points is essentially a 15 percentage point shift in their overall mix, right?
Yes. In financial terms, 100 basis points equal 1%.
Right.
So a 1,500 basis point shift is a massive structural reallocation of their entire business model. Spot freight expanded to make up 42% of their total truckload volume in the second quarter.
Wow, 42%.
And it actually accelerated. By July, it hit 50% of their truckload volume.
Half of their entire truckload business was suddenly operating in this high-margin, real-time pricing environment.
Exactly.
Okay, we mentioned earlier that they had a phenomenal gross profit bump. Break down the margin magic for us. I mean, how did that 50% spot mix actually translate to the bottom line?
The sources show that this pivot to the spot market drove an 11% sequential increase in truckload gross profit per load in Q2.
Okay, so from Q1 to Q2, the pure profit they made on every single truck they matched went up by 11%.
Yes, on a per load basis. And then we look at the July numbers, which are even crazier.
Hit me.
In July, their truckload gross profit per load jumped roughly 40% compared to where it was in January 2026.
40%.
Yeah. If you strip out the cost of fuel and you adjust for the length of haul, their revenue per load was actually up more than 25% year over year in July.
So just to recap this, the overall freight pie isn't getting any bigger. We established that actual shipments are down. But RXO's platform is sitting there like a massive catcher's mitt, catching all the overflow from the broken contracts. They are capturing high-margin loads in a soft economy. So it acts as a financial shock absorber, but also a massive profit multiplier.
Absolutely. Management explicitly noted in their earnings call that this is the playbook. They have built an architecture specifically designed to monetize the chaos caused by this supply attrition.
Monetizing chaos. I love that phrasing.
Yeah.
But, monetizing that chaos requires an infrastructure capable of actually handling the volatility.
Right, you have to be able to execute.
Exactly. And this is where the physical reality of the business clashes with the numbers for me. Because if half your business suddenly shifts to unpredictable, real-time spot market freight, that usually requires a massive human war room.
It's extremely labor-intensive historically.
Right. In a traditional brokerage, you need an army of dispatchers frantically calling carriers, negotiating rates over the phone, sending thousands of emails, verifying insurance documents. I mean, if volume surges 50%, your payroll usually surges 50%. So how did RXO absorb that kind of chaotic volume without their overhead just completely exploding?
And the answer to that lies in their proprietary technology, specifically their AI productivity modes.
Ah, AI, of course.
They have managed to fundamentally decouple freight volume growth from headcount additions.
Decoupling volume from headcount. I mean, scaling the top-line revenue without scaling the payroll expense. If you can actually pull that off in a services business, you've essentially found the holy grail of margin expansion.
It really is.
So how are they actually doing it?
It revolves around a very deliberate deployment of machine learning. So during the Q2 earnings call, the CEO highlighted that they had aggressively replaced legacy third-party software with their own internally developed AI tools.
Okay.
And the most prominent example detailed in the sources is their autonomous spot, quote, AI agent.
Okay, hold on. I hear AI agent, and I immediately picture a glorified out-of-office macro just spitting out a static rate card to anyone who emails them.
It's a common misconception.
Right, because if it's just looking up a price on a spreadsheet and hitting reply, anyone could code that in a weekend. What makes this tool actually intelligent?
Well, it is light years beyond a simple macro. The true intelligence lies in the dynamic freight matching mechanism.
Okay, explain that.
When an email comes in from a shipper requesting a spot, quote, say, for that desperate load of paper towels from Atlanta to Dallas we talked about, the AI isn't just checking a static rate table.
What is it doing?
It is instantly evaluating real-time market capacity, historical pricing patterns, and, crucially, carrier lane preferences within their specific network.
Okay, carrier lane preferences. Give me a real-world example of that. How does the AI use that to price a load?
Let's say the AI knows there's a specific independent trucker who lives in Dallas,
Right.
but they just dropped off a load in Atlanta. So that driver is now sitting empty in Georgia, and they are desperate for what the industry calls a backhaul.
A backhaul, Meaning a load that pays them to drive back toward their home base.
Exactly. They want to go back to Texas anyway.
Yeah.
The AI recognizes that this specific driver is in the area and is highly likely to accept a slightly lower rate just to avoid driving an empty truck hundreds of miles for free.
Oh, that is smart.
So the AI algorithm factors that highly probable, cheaper capacity into its pricing logic, and it instantly emails the shipper a highly competitive quote.
And it does all of that in milliseconds.
Milliseconds.
So speed to quote becomes the actual weapon here. Because if a shipper's panicking because their truck didn't show up, the very first viable competitive quote that hits their inbox is usually the one they book, right?
Precisely the strategy. And during the second quarter, this specific AI agent processed 5 times more email quotes per day autonomously compared to prior periods.
5 times more, without hiring a single new person to answer emails.
Right. And when the AI returns that quote instantly and the shipper accepts, it allows the human customer representative to just book the load within their native interface in seconds. It completely bypasses that whole manual negotiation phase.
That's incredible. And I assume it's operating on the carrier side as well, right? Like getting the trucks to actually bid on the loads?
Yes, it is. Through their digital platform, which they call RXO Connect.
Okay.
The automated matching drove a 25% sequential increase in digital carrier offers. So the truckers are actually interacting directly with the algorithm, not a human dispatcher.
Bypassing the phones entirely.
Mostly, yes.
Yeah.
Furthermore, in their managed transportation division, they reported a roughly 50% increase in agentic phone automation.
Wait, phone automation, like AI talking on the phone?
Yes, they are using AI to handle routine check-ins, load tracking, and basic dispatch over the phone,
Wow.
which frees up the human workforce for complex problem-solving and relationship building.
Okay, let's connect all this technology directly back to the income statement. Because, you can have all the fancy tech in the world, but if it doesn't actually show up in the margins, it's just an expensive science project.
That's the ultimate test.
Did it actually save them money in Q2?
The forensic audit of their financials proves that it absolutely did. Because of these automation tools, RXO grew their brokerage volume by 2% year over year.
Okay.
However, while they were moving more actual freight, their direct operating and SG&A expenses, sales, general, and administrative expenses, actually fell.
Wait, SG&A dropped while volume grew. By how much?
It dropped from 15.1% of revenue down to 11.9% of revenue.
That is massive. I mean, you grow the top line, you shrink the middle line, and the bottom line profit just expands exponentially.
It validates management's claim during the Q&A session that they're currently, quote, staffed for growth.
Yeah.
The CEO stated on the record that they have the architecture in place to absorb a 15 to 20% increase in volume overnight without needing to add proportional headcount.
So the AI provides the elasticity. They can scale up during a massive spot market surge without taking on the fixed, permanent costs of human capital.
Precisely. It's highly efficient.
It's a brilliant model,
Yeah.
and there's always a but, an AI pricing engine is ultimately only as good as the physical network of trucks it can actually tap into.
Right, the real world matters.
If the algorithm spits out the perfect price based on that Dallas driver sitting in Atlanta, but RXO doesn't actually have a relationship with that Dallas driver, the kind is worthless.
Completely worthless.
So to feed that AI engine, RXO needed massive scale. They needed liquidity in the physical market.
Yes, technology without liquidity is just software. And that brings us directly to the integration of Coyote Logistics.
The Coyote acquisition.
The Coyote acquisition provided the physical liquidity required to make the AI engine truly dominant.
Okay, let's audit this acquisition. Because Coyote was a massive player in the brokerage space. And frankly, integrating a giant company like that is usually a complete nightmare of redundant software and culture clashes.
It often destroys value, yeah.
Right. So what did buying Coyote actually do for RXO's numbers in Q2?
Well, the primary metric analysts look at during an integration is synergy capture.
Basically, are they actually saving the money they promised they would save when they pitched the deal?
Exactly. And the Q2 reports indicate RXO successfully realized $70 million in total cash synergies. And they did it ahead of schedule.
$70 million. Okay, how does that break down operationally? Where did they find the fat to cut?
It breaks down into $60 million in operational expense savings and $10 million in capital expenditure savings.
Where does the OpEx savings come from?
The OpEx savings largely come from eliminating redundant administrative roles, combining the real estate footprints, and shutting down legacy, expensive third-party IT contracts that Coyote was using.
Right, bringing everything onto RXO's proprietary platform.
Exactly. And the CapEx savings come from no longer needing to invest in parallel software development.
But the real prize wasn't just cutting the IT budget, was it? It was purchasing scale.
Purchasing scale is the key concept here. The Coyote acquisition elevated RXO to become the third largest freight broker in North America.
Third largest. That's huge.
They inherited Coyote's incredibly dense carrier network. This included deep, multi-year relationships with medium and large carrier fleets, as well as access to private and dedicated trucking fleets that RXO previously couldn't easily tap into.
Okay, how does having access to those private fleets change their financials? Walk us through the mechanism of their buy rates.
Okay, so a buy rate is simply the cost RXO pays to the trucker to move the load.
Right.
And the sell rate is what they charge the shipper. The difference between those two is their gross margin.
Makes sense.
By utilizing this newly combined, incredibly dense network of carriers, RXO improved its contract buy rates by more than 25% relative to market benchmarks.
Wow. So, just to give an example, if the average market rate to hire a truck for a specific route is $1,000, RXO is getting it done for $750.
Exactly.
Simply because they have so much volume to offer these large fleets that they get a massive wholesale discount.
That's it. When macroeconomic capacity tightens, as we establish it currently is, the ability to secure cheaper capacity acts as direct cost avoidance to the profit and loss statement.
Direct to the bottom line.
Yep. And this massive scale had a secondary benefit. It allowed them to revive dormant business.
The volume reacceleration. This was a really fascinating detail in the segment breakdown for me.
It's a great sign of a healthy integration. The increased scale, combined with the improved service metrics driven by the AI, allowed RXO to re-engage legacy Coyote customer bases.
Which is hard to do, right? Because often during an acquisition, customers get nervous about the transition and they just pull their freight.
Very common. But the sources map out the core legacy verticals, specifically automotive, food and beverage, and retail and e-commerce, all returned to positive year-over-year volume growth for the first time in 2 years.
2 years of shrinking, and suddenly they are growing again under RXO.
Yeah.
So the playbook here is pretty clear. Buy Coyote, strip out the redundant $70 million in costs, plug Coyote's massive carrier network into the RXO AI engine to buy trucking capacity 25% cheaper, and then use that pricing power and reliability to win back massive enterprise accounts.
It is a ruthless, highly effective strategic maneuver.
It really is. But, massive scale in the freight industry brings a terrifying shadow. With scale comes extreme liability. And in logistics, liability is the ultimate existential threat.
It really is. This is the part of the business that keeps executives awake at night.
Right, because if you are a freight broker and you hire an independent carrier and that carrier causes a catastrophic, fatal accident on the highway, the legal fallout doesn't just hit the truck driver, it can completely destroy the broker.
Yes.
Yeah.
And the rules of the game just changed entirely.
Let's talk about that because the entire industry is currently navigating the fallout from this precedent-setting Supreme Court case, Montgomery v. Carib Transport.
Yes, Monco.
Break the mechanics of this ruling down for us. Why is everyone so panicked? And just to remind the listeners, we're looking at this strictly from the operational business impact detailed in the sources.
Of course. To remain strictly impartial on the legal merits, we will focus solely on the functional, operational impact outlined in the sources.
Perfect.
The Supreme Court's ruling in Montgomery narrated what is known as FAA preemption.
The Federal Aviation Administration Authorization Act. A total mouthful of an acronym. What did it actually do for brokers before this ruling?
Historically, the FAA provided a degree of federal protection. It acted as a shield for freight brokers against certain state-level claims regarding how they conduct their business.
Okay, a federal shield.
Right. But the Montgomery decision effectively pierced that shield. It explicitly exposed third-party freight brokers to state-level negligent hiring lawsuits.
Negligent hiring. Meaning, if an accident happens, the victim's lawyers don't just sue the truck driver who caused it.
No, they don't stop there.
They sue the broker who hired the truck driver, arguing, you should have known this carrier was unsafe. You were negligent in matching them to this specific load.
That is the exact mechanism of the lawsuits. And in the current legal climate, these cases frequently result in what the industry calls nuclear verdicts.
Nuclear verdicts.
These are multi-million dollars, sometimes tens of millions of dollars jury awards. A single nuclear verdict can bankrupt a mid-sized brokerage overnight.
Just wipe them out completely.
Exactly. The Montgomery ruling sent an absolute earthquake through the insurance and logistics markets.
So during the Q2 earnings call, the Wall Street analysts were hounding management about this liability, right? They wanted to know if RXO was exposed.
They definitely asked about it.
But instead of getting defensive, RXO essentially took a victory lap. They detailed how they have turned this massive legal threat into a commercial weapon. They literally call it their post-Montgomery legal fortress.
Which is a great marketing term.
Yeah.
But the fortress actually relies on enforcing incredibly strict, highly differentiated carrier vetting standards that far exceed industry norms.
Okay, let's contrast their standards with the rest of the market. Because when capacity is tight, like we know it is right now, a lot of smaller brokers will hire basically anyone with a pulse and a steering wheel just to get the freight moved.
Oh, definitely. Smaller, underinsured competitors will absolutely cut corners to find cheap capacity.
But not RXO.
No. RXO enforces absolute, non-negotiable barriers to entry on their network. First, they permit 0 conditional safety carriers.
0.
0. If a trucking company has received a conditional safety rating from the FMCSA for past violations, they are entirely banned from hauling for RXO.
Okay, what else?
Second, they enforce a strict 90-day minimum active authority requirement.
Meaning a brand new trucking company can't just incorporate on Monday and take an RXO load on Tuesday.
Correct. They need 3 continuous months of proven, verifiable operational history before RXO will even look at them.
Which weeds out the fly-by-night operations.
Exactly. And the most crucial layer of this fortress is the mandatory human touch verification.
Wait, really? With all their talk about AI and automation, I just assumed they were auto-onboarding carriers?
No, they aren't. Before a carrier is allowed to book their very first load on the RXO platform, a human compliance expert must manually verify their insurance credentials, check their safety history, and physically speak with them.
So a real person has to sign off?
Yes. And RXO has deliberately separated their compliance division from their sales division.
Oh, that's a vital structural detail.
Very important.
Because the sales guy whose bonus depends on moving that load of paper towels has absolutely 0 authority to approve the truck driver. There is no operational bias allowed.
Exactly. It removes the conflict of interest.
And then, backing up all of this vetting, is their actual insurance tower.
Right. And the chief financial officer detailed their insurance financials quite transparently, which is actually pretty rare.
What are the numbers?
RXO spends between $15 million and $20 million annually just on casualty insurance premiums.
Just on premiums?
Yes. Furthermore, they carry a $5 million per occurrence deductible.
A $5 million deductible? Just think about the mechanics of that for a second. If there is a catastrophic accident, RXO has to write a cash check for the first $5 million out of their own pocket before the insurance company pays a single dime.
Correct. You have to have an incredibly strong balance sheet to absorb that kind of risk.
You really do.
And the sources note that this specific structure, the high premiums, the massive deductible, places their insurance tower in the top percentile of all asset carriers and brokers in North America.
So how does spending $20 million on insurance act as a commercial wedge? Like, how does that actually win them business?
Well, consider the perspective of the Fortune 500 enterprise shippers.
The big guys.
Right. They are just as terrified of nuclear verdicts as the brokers are. Because if a plaintiff sues an underinsured broker and that broker goes bankrupt, the lawyers don't stop.
Right, they go after the deep pockets.
Exactly. They move up the chain and sue the shipper who manufactured the goods. Therefore, shippers are actively redesigning their supply chains in what the industry calls a flight to safety. They are consolidating their freight routing guides. They are stripping business away from small, risky brokers and giving it exclusively to massive players like RXO who can definitively prove they are fully insured and rigorously vet their carriers.
So the legal liability is literally driving customers into RXO's arms.
Yes. And there is a ticking clock accelerating this trend right now.
Oh, what's the clock?
The sources highlight that late December 2026 is when many of the annual casualty insurance policies are up for renewal across the entire logistics industry.
Oh, wow.
Because of the Montgomery ruling and the rising frequency of nuclear verdicts, smaller competitors are going to face absolute crushing premium hikes.
They won't be able to afford it.
Some won't be able to secure coverage at any price. But RXO, with its top-tier safety record, expects a much more favorable renewal outcome.
positioning them to capture even more market share as their competitors are literally forced to exit the market.
Exactly.
It is wild. The very thing that threatens to destroy the industry is becoming RXO's strongest competitive moat.
It's a fascinating dynamic.
Okay, we have explored the macro supply constraints, the AI pricing engine, and this massive legal fortress. They are dominating truckload brokerage. But RXO is a complex machine with complementary engines. And as we looked at the total financial picture, we really have to examine how these other divisions are performing.
Because they aren't all booming.
Right. Because one of them is creating a significant headwind.
We need to dissect the performance of their complementary services division, which primarily consists of managed transportation and last-mile logistics.
Okay, let's start with the bright spot. Managed transportation. What is the mechanism of this division?
Managed transportation is where RXO effectively acts as the completely outsourced logistics department for a shipper.
So they just handle everything.
Everything.
Yeah.
Instead of just booking a single spot load here and there, they secure 3 to 5 year enterprise contracts to manage the shipper's entire network end to end.
Got it. And how did they do in Q2?
In Q2, this segment was highly successful. They captured $100 million in new freight under management, or FUM.
That's a lot of freight.
And the momentum continued. They captured another $100 million of FUM in July alone.
$200 million in new freight management in 4 months. What was driving that massive surge?
The sources point specifically to a nearly 30% surge in time-critical automotive ground expedite.
Automotive expedite. Walk us through a scenario there, because that sounds intense.
It is. Modern automotive manufacturing relies on just-in-time assemble lines.
Right.
They don't warehouse thousands of parts. The parts arrive exactly when they are needed on the line. But as macroeconomic trucking capacity tightened in Q2, these manufacturers suddenly faced the massive risk of parts not arriving on time.
And if the parts don't arrive?
A halted automotive assembly line can cost a manufacturer millions of dollars per hour.
Millions per hour.
Yeah. Therefore, they urgently contracted RXO to provide expedited, guaranteed freight management to prevent plant shutdowns. RXO capitalized on this high-margin urgency.
The auto manufacturers will happily pay a massive premium to keep the line moving. That's a great win for RXO. But let's contrast that success with the last mile logistics division.
Right, the last mile.
Because this is where the financial headwinds are blowing hard.
Last mile logistics focuses on the final delivery of big and bulky items directly into consumer homes.
We are talking about refrigerators, massive sectional couches, exercise equipment, washing machines.
Exactly. On the surface, the Q2 volume metrics looked acceptable. Their total delivery stops were actually up 3% year over year.
Which indicates they are still taking market share from competitors.
Yes, but you have to look at the Q3 forward guidance.
Okay, what did management project?
They projected a $3 million to $5 million sequential EBITDA headwind in Q3, originating just from the last mile division.
A $3 to $5 million hit to profits. Why the sudden compression if stops are up?
It is driven by a combination of macroeconomic housing softness and carrier cost inflation.
Unpack the housing part.
The primary driver is the frozen housing market. With mortgage rates remaining elevated, consumer mobility is way down, fewer people are buying homes or moving into new apartments.
Right, and when you don't move, you don't buy a new refrigerator, you don't buy a new living room set.
Exactly. Consumer demand for heavy goods is heavily correlated with housing turnover, so the revenue potential per stop is depressed.
Okay, so revenue is down. And what about the costs?
Well, combine that lower revenue environment with rising carrier cost inflation.
Meaning the labor costs more?
Yes. The actual
Or-
cost to hire the independent contractor teams who drive the box trucks and physically carry the washing machine up the stairs is increasing.
So you get classic margin compression. Fewer high-margin items being delivered, and the ones they do deliver cost more labor to fulfill.
It's a brutal squeeze.
It is. But honestly, as much as a $3 million headwind stings, it pales in comparison to the massive, scary number we touched on at the very beginning of this deep dive.
Oh, yes. The paradox.
The paradox. In Q2, RXO reported an adjusted free cash flow deficit of negative $42 million.
The cash bleed.
Exactly. We literally just spent an hour talking about how revenue is booming up to 1.77 billion. The spot market is highly profitable. AI is cutting overhead costs. So how on earth does a company with exploding profitable revenue bleed $42 million in cash in 90 days?
It is the ultimate early cycle
Yeah.
paradox, and it requires a really forensic breakdown of their working capital
Right,
dynamics.
you're right.
Because this negative cash flow is not a sign of structural failure. It is actually a direct symptom of their incredibly rapid growth. It is a working capital squeeze.
Okay, break the mechanics of that squeeze down for us. Where is the cash actually going?
In the freight brokerage model, the timing of cash inflows and outflows is highly asymmetrical.
Meaning money doesn't come in and go out at the same time.
Right. When RXO's revenue expanded by 25% in Q2, driven heavily by those expensive, desperate spot market loads we talked about, RXO incurred the immediate liability of paying the truck drivers.
Because a truck driver who takes a spot load from Chicago to Atlanta doesn't want to wait a month to get paid. They have fuel to buy. They expect a check the minute they drop the trailer.
Precisely. And RXO facilitates this immediate payment through programs like Carrier QuickPay, which saw heavy utilization in Q2.
So massive amounts of cash are just flowing out of RXO's bank accounts to the carriers almost instantly.
Instantly. However, the shippers on the other side of the transaction, the massive corporate retailers and manufacturers, they operate on standard net 30 or net 60-day payment terms.
They take 1 or 2 months to actually pay RXO the invoice for that exact same load.
Exactly. Because revenue spiked so violently and suddenly in Q2, this timing mismatch was wildly exaggerated.
RXO was fronting the cash to the truckers while waiting up to 60 days for the corporate shippers to pay up.
That's it. And this specific dynamic drove a massive $223 million increase in accounts receivable on their balance sheet.
$223 million sitting in accounts receivable. So their cash isn't gone. It is literally trapped in transit. It's tied up in outstanding invoices.
Yes. And that perfectly explains the negative $42 million free cash flow. It's a cash flow timing issue, not a profitability crisis.
Wow.
It is purely temporal. And the financial models provided in the sources predict that as the initial shock of that revenue growth stabilizes, this dynamic will actually trigger a massive cash flow reversal.
Right, because all those invoices will finally come due.
Exactly. As those 60-day corporate invoices finally get paid in the second half of the year, that trapped working capital will unwind, resulting in significant positive free cash flow generation in Q3 and Q4.
Okay, that makes complete sense. Which brings us to the final synthesis of this whole deep dive.
Let's bring it together.
We've looked at the regulatory forces pulling trucks off the road, the AI tech engine maximizing the spot market margins, the legal fortress protecting them from nuclear verdicts, and we've audited the working capital cash squeeze.
Right.
Let's do a final capital structure audit, because if they're waiting on $223 million in invoices, how are they keeping the lights on today? What does their balance sheet actually look like?
Management has strategically refinanced the balance sheet specifically to weather these exact cyclical working capital swings.
Smart. When did they do that?
In February 2026, RXO proactively issued $400 million of senior notes, and those don't mature until 2031, locked in at a 6.375% interest rate.
Okay, so pushing out the maturity so they don't have a massive bill coming due anytime soon. They use that to redeem older debt.
Yes, older, more expensive debt.
But what about day-to-day liquidity to float those immediate trucker payments?
They secured a massive $450 million asset-based lending, or ABL, credit facility.
An ABL. Okay, for the non-accountants listening, that essentially means they are using their own assets, like those $223 million in outstanding invoices, as collateral to secure a massive line of credit from the bank, right?
Exactly. And at the end of Q2, they had $335 million of available borrowing capacity on that ABL. Combine that with their cash on hand, and they have total liquidity of roughly $350 million. Furthermore, the ABL includes an uncommitted accordion feature.
Hold on, an uncommitted accordion feature? That sounds like a musical instrument, not a financial instrument. What does an accordion feature actually let a CFO do?
An accordion feature is a clause in a loan agreement that allows the borrower to expand the maximum size of the credit facility, to stretch it out like an accordion under certain pre-agreed conditions without having to negotiate an entirely new loan.
So if RXO spots another acquisition opportunity like Coyote, or if revenue spikes even harder, they have the pre-approved mechanism to access even more capital quickly.
Exactly. It's a phenomenal amount of dry powder.
It is. But we do need to address their debt ratio. We mentioned in the intro that their net leverage ratio was sitting at 4.1 times their trailing bank-adjusted EBITDA.
Yes.
For a highly cyclical business, carrying 4 times your earnings in debt sounds precarious.
It is elevated, certainly, but the trajectory is the critical metric for investors here. That 4.1x net leverage ratio is a backward-looking metric.
Backward-looking, because it's based on the trailing 12 months.
Yes, which inherently includes the darkest depths of the recent freight recession. Management maps out a very clear deleveraging path.
How does the math work to get that ratio down?
As the much higher adjusted EBITDA from Q2 and the anticipated strong Q3 begin to replace those weak historical quarters in that trailing 12-month calculation, the denominator of that ratio grows.
The earnings grow.
Right. And simultaneously, as that trapped working capital cash drag reverses and generates cash in the second half of the year, they can actually pay down the debt, the numerator.
Okay.
Models project this dual action will drive net leverage down sharply from 4.1x toward roughly 3.0x by year end.
So, the balance sheet is armed, the debt is manageable, and the margins are expanding. What is the final verdict from the financial analysts on the core investment thesis for RXO?
The consensus synthesis of the sources is that RXO represents a premier asymmetric recovery compounder.
Asymmetric recovery compounder.
They are an asset-light platform that has emphatically proven it can seize market share and expand profit margins early in a supply-constrained cycle.
And as the cycle matures,
As this freight cycle matures and consumer demand eventually normalizes alongside this structurally constrained truck capacity, the platform is capable of scaling toward normalized mid-single-digit EBITDA margins.
what does that look like in pure dollars?
At peak operational utilization, the financial model suggests this business can generate between $300 million and $450 million, or potentially more, in annual adjusted EBITDA.
Generating nearly $500 million in profit without owning a single truck. It's a staggering target.
Truly staggering.
But, to maintain a balanced view, we have to look at the downside. What are the core execution risks? What are the 3 things that could derail this entire thesis?
The sources outline 3 primary risks that must be monitored. The first, as we discussed, is sustained housing weakness.
Right.
If mortgage rates remain stubbornly high and the housing market stays frozen, the last mile division's profitability will continue to act as an anchor on overall earnings.
That makes sense. And the second risk?
The second risk is fuel price volatility.
Wait, how does fuel hurt them if they don't actually own the trucks? Don't they just pass that cost along?
They do, but it creates an accounting gross margin lag. Rapidly rising fuel prices trigger fuel surcharges that pass through RXO's revenue line, artificially inflating the top line without generating any actual gross profit dollars.
Oh, I see.
This mathematically compresses their margin percentage, making the business look less efficient on paper, even if absolute profit dollars are steady.
Right. Revenue looks bigger, profit stays the same, so the margin percentage physically shrinks. Okay, and the third risk?
The third, and perhaps most volatile risk, is the threat of casualty insurance inflation.
Back to the nuclear verdicts.
Exactly. Even with their post-Montgomery legal fortress and top-tier safety record, a systemic shock to the broader insurance market at the December 2026 renewals, perhaps driven by a cluster of massive nuclear verdicts against other brokers, could force RXO's premiums significantly higher than modeled.
Which directly eats into operating income.
Directly.
Those are massive, uncontrollable macroeconomic hurdles. But based on the data we just walked through, they seem exceptionally well-positioned to navigate them.
They really do.
Which leaves us with a final, provocative thought to mull over. We spent a lot of time analyzing their AI quoting engine, the dynamic pricing, the incredible efficiency of matching trucks to loads in milliseconds.
Right, the tech moat.
But let's extrapolate that technology out into the future. If AI eventually automates the shipper's pricing logic and simultaneously automates the broker's pricing logic, does the fundamental information asymmetry that creates brokerage margins completely collapse?
That's a deep question.
I mean, if 2 hyper-intelligent algorithms are just perfectly matching supply and demand in milliseconds, finding the exact true market clearing price instantly, there is no human inefficiency left to capture. There's no margin left to squeeze.
It is a highly compelling scenario.
Yeah.
It suggests that pure technological transactional matching eventually becomes just a zero-margin commodity.
Exactly. And in a world where AI perfectly matches supply and demand without friction, perhaps the only true, unassailable competitive advantage left for a freight broker won't be their algorithm or their technology at all.
What will it be?
It will be the human touch legal liability shield, the capacity to absorb a $5 million deductible, the rigorous human vetting of a driver's safety record to prevent a nuclear verdict. The very analog physical fortress that RXO is building right now might be the only moat that actually survives the AI revolution.
That is a very powerful thought.
Think about that the next time you see an 18-wheeler on the highway.